Against the backdrop of a raging COVID epidemic and a quite visceral Black Lives Matter movement, Abroad While Black was born. Our goal was to highlight Black perspectives from all over the world. It was our way of proving there are other ways to live, other places to be successful, in different cultures that embrace our Blackness. In 2020, the Abroad While Black team created dozens of responsive hot takes and thoughtful interviews covering topics ranging from current events, business opportunities, dating, and life-changing moments. In 2021, our co-hosts Cordy and Sean aim to share more success stories, more productive introspection, and most importantly, how to relocate to a place that truly values what you offer the world. Abroad While Black is more than a show. This is a social experiment hell-bent on discovering new ways to secure the bag and live our best lives. Join the Abroad While Black squad.
Awesome. So it's great to have you on, man. Please give me a little bit of background. Tell us about yourself.
Okay, my name is Uwem, like you already know. I lead fund operations at a venture capital firm called Ingressive Capital. I dare say one of the best venture capital firm on the west coast of the African continent. We have investments in over 20 companies across sub-Saharan Africa, Nigeria, Kenya, Ghana, and hopefully in Egypt. Prior to this, I also led one of the largest philanthropic efforts towards entrepreneurship on the African continent, which was the Tony Element Entrepreneurship Program, which I led for give or take 5-6 years, where we trained, mentored, and funded about 10,000 plus entrepreneurs across the African continent. So
amazing.
That's me in a nutshell.
Yeah, and you said it so humbly, so laid back. I mean, I think I would have might have had a band playing in the background or something. But I work for everybody who's watching any of the other episodes we record. I'm always shouting you guys out. You know, we're one big happy family and whatnot. And with that being said, since we are one big happy family, often people don't know the difference between Ingressive, just Ingressive Advisory Company, Ingressive for Good, Ingressive Capital. So with that being said, people assume I'm part of the fund, the VC fund. And I am not. You know, we're all trying to be supportive and we help each other and whatnot, but I'm not an investor by trade. I just kind of had to study up on it to help people who are coming to me trying to get to you. And one of the major things that I find myself going through, either from the perspective of the investor, very, very early stage, people at the ideation stage, building out a concept, starting to operate, you know, somehow at small stages. They're kind of lost when it comes to the conversation of valuation. And I thought that, I can just Google it, look at it, ask people a few questions and then I did that. And then I did it again. And I was like, I get it, but I still don't get it. So I guess today we're going to kind of jump into like valuation. Like, what is it? How do people do it? How does that happen?
I mean, even the most seasoned entrepreneurs and investors struggle with the conversation around valuation. To me, I see it as an art and not a science, because there are different methods to get to your valuation, but it's still very subjective. So it depends on who is looking at it or who is reviewing it. However, there are universal, would I say, standards to looking at valuation. But before we talk about valuation, you need to know there are certain terms you need to know about. You need to know what equity is. Basically, equity is a percentage ownership of any company or ownership of any company. You must also know terms like what dilution is. So dilution is the decrease in ownership of a company that occurs when you sell your equity, or you sell your shares in your company to other people, right? Mm-hmm. You must also know terms like pre-money valuation. So now we're getting to the very interesting part. Now, pre-money valuation is the valuation of your company prior to taking in money from any other person. While you also need to know post-money valuation. Post-money valuation is the valuation of your company after investment. So say, for example, you say your company worth $2 million. So the valuation of your company is $2 million. Post-money valuation, if you take in $200,000 from a venture capital firm like Ingressive, will now become $2.2 million. That's $2,200,000 So you see what I did there. Your valuation plus the money you take in is your post-money valuation. But now let's even go into the nitty-gritty. So there are many ways to come to, I wouldn't say to, there are many ways to calculate what your valuation is, or come to that conclusion of what your valuation is. However, I'm going to talk about four very popular methods, because there are many, right? Like I said earlier, it's more of an art than a science. Many people have different ways of calculating it. And I tell people that your valuation conversation ends up being a negotiation between the entrepreneur and the investor. So the entrepreneur says, oh, I think my valuation is $6 million. The investor obviously wants to, will try to haggle because he wants the best for his business. He will say, no, I think your valuation is 3 million. Then the entrepreneur comes back to say, no, I put in so much work. I have this, I have that. You know what, let's settle at 5 million. So you see how valuation can, go up and down depending on how much value you perceive has gone into the business. But let me talk about the four methods of coming across your valuation or calculating your valuation. The very first one is called the comparison or comparable pricing method. And basically what you do is you look for a similar company like yours in probably the same country or a similar market doing the same thing you're doing. And then you figure out what they say their valuation is. So say, for example, now, let me give what local companies in Nigeria. I'm going to just use a popular example. Coca-Cola right now in Nigeria, assuming that they're not a global brand, they're a Nigerian company, right? We'll look to India and say, what is Pepsi doing in India? How much they value their company? And in India, Pepsi is valuing their company at, let's say, 32 billion. Coca-Cola will say, okay, because India is valuing their company, Pepsi is valuing their company in India at 32 billion. Looking at the markets are similar in terms of size, in terms of people, in terms of the poverty level, in terms of so many things, in terms of policies. That means the value of my company is 32 billion because a similar company in a different climate, but the same, environment is valuing at that price. So that's the comparable pricing method, looking at similar companies in similar markets and benchmarking against what they say the valuation is. That's probably the easiest way to go about your valuation. It's not the most accurate, but it's good for early stage companies, really, especially when you don't have the expertise in-house to, do the mathematics and review your cash flow and do all those things to come across your valuation. So you can just do a comparable, pricing method to get your valuation. The second method is called the scorecard method, which is a bit more tricky, but is used more by angel investors. So you look at all the companies in the market, right? And then you compare the company you're evaluating against them. And then you find the average, the average value of their valuation and say, hey, this is where this company fits in. So look at, let's say I'm a new entrant in the fintech space in Nigeria. I look at all the fintech startups in Nigeria, look at their value, and then come to an average and say, hey, my company is this value because this is the average value of all the fintech companies in Nigeria, right? Chances are when you use this method, you're going to have a very high valuation, but it kind of shows the promise, shows that the investment is a promising opportunity, because if the valuation of similar companies in the same market is very high, it kind of tells investors that, oh, okay, well, maybe there's something good going on here. So you ask the scorecard method. That's method number 2. Method number 3 is the discounted cash flow method. And usually you need a financial expert to do this. So basically, this is actually more difficult, and a lot of PE firms actually do this because this kind of gives the true value of it gives you a true sense of the valuation, but it's never correct. Like I said, valuation is an art and not a science, because various factors can affect valuation and affect the growth of a company. And to be honest, look at how COVID messed up a lot of things. A lot of companies value themselves at a certain, range, and then COVID hits and businesses were failing and they had to downsize or do a down round and say, hey, my valuation is no more 10 million, I'm now 2 million, right? Because, things didn't happen the way they ought to, happen. So the discounted cash flow method is basically looking at the expected rate of return of a company. So saying, company X is operating in Nigeria, and they're projecting that in the next 5 years, company X is going to make X million based on the number of people are available in Nigeria, 200 million, which we are still not sure about, based on how much they can get in profit. And based on how much return we can get from this company when we invest in this company. So if we look at all this, right, this is the valuation of the company, because you're banking on the future profits, or how well the company will do in the future. That's the discounted cash flow method. That's why it's called the discounted cash flow. You look at the cash flow, the returns and all, and put your valuation based on it. Now, the problem with this method is, remember how I talked about COVID? Things like COVID can happen and boom, all your projections in the mud. And then your valuation just drops, So that's why I said, the valuation conversation is a very tricky one. And the last method is the cost to duplicate method. And this is the easiest, really, because you can sit down in your house and do it. The cost to duplicate method. So basically, you're valuing your company based on how hard it is for a competitor to duplicate your business. And the way you do that is to look at the amount of hours you spent building your software, or building your solution. Look at how much time you spent on research. Look at future sales. Look at potential for no. You don't take into account future sales and potential for growth. You just take into account everything you put into the business. So cost of research, cost of development, all, and you factor in all the time you spent, drawing, writing your business plan and everything, and you put a monetary amount on that. So that's the cost of duplicate method. Now this is the easiest, but unfortunately, a lot of times when you use this method, you kind of undervalue your company, because you're not looking at the future potential of your company. You're looking at how much you have invested in now and how hard it is for someone to replicate the same business. So those are the the four methods that I like to talk about a lot, and they're the easiest to understand. There are many other methods, but these are the four main methods that people across the world apply.
Okay. So I have to ask the obvious question then at this point. Yeah. When companies are approaching you, then which is technically your preferred method? Like, which method would somebody do that makes you feel like, okay, I have the most confidence in this person?
To be honest, we actually do a mix. It's a mix and match. So if I'm talking to you, the first time I speak to you, I'm already thinking about how hard it is to duplicate your business. So in my head, I'm calculating the cost to duplicate method, right? How much will it cost to replicate this kind of business? But then again, when we are in depth into due diligence, we sort of employ the discounted cash flow method. So in the sense that we ask you to send us your projections, and we look at how much you want to make, over a long-term period. And then we say, okay, because this company looks like it's going to be valuable, these are the amount of partnerships they've signed. This is the potential customers they can gain in 2 years, 3 years. This should be the value that they should be valuing themselves. So sometimes you see a case where somebody reaches out to us and we think their valuation should be higher.
Mm-hmm. Okay.
Yeah, it does happen. It does happen. And very good investors will actually tell you your valuation is actually very low. You are underselling yourself. Good investors will do that. To be honest, good investors will actually tell you, because it also affects them when they invest in you, because you're not valuing you're not giving the true value of the work you've put into the company. So yes, we it's a mix and match. We don't necessarily have one method. We use different methods depending on type of company we're speaking to. And then the sectors also determine. So a software as a service company will probably use a discounted cash flow, because it's a software service, it's a subscription-based model. So you can sit down and calculate future earnings and all that easily, compared to maybe a service-based company and all that.
Okay. Yeah. Okay. That makes sense. Okay. So I was just afraid of it. I think what I came across when I started Googling things and getting my YouTube PhD was a lot of complex formulas. And when I saw the complex formulas, there were two things that I was advising people to do. I was saying basically, like, no matter what you do, you should understand how to calculate your own valuation.
To be honest, and this is coming from somebody that I do not like calculations, I don't like maths, but I'm in the venture capital space. You don't need to know everything. I keep on telling people, but you need to know a bit of everything. You see what I did there? You don't need to know everything, but a bit of everything. Okay. Which means you understand how valuation is calculated, but you don't need to know how, all the formulas and all. Oftentimes, like I said, you use a comparable method, and let somebody negotiate with the other investor. Let the investor say, no, this is too high. This is what I think it should be. So that you don't undersell yourself, because oftentimes, and too many times, entrepreneurs end up underselling themselves when they want to do everything themselves. So it's okay to have a high valuation, no, a sensible valuation. Don't go too high. And the easiest way is to look at, comparable businesses at the stage, at your own stage. Look at how much you've invested in the business and come to evaluation. A good example is there's a company that we're speaking to. I can't mention the name. And when we spoke about, he gave us a valuation and we felt it was too high. But his response was, hey, I invested $300,000 in 2019. I did this. Hence, the valuation has to be this high because I have skin in the game. I've actually invested so much time and money into it. And it made sense, right? And we said, okay, well, let's go with it. So in the end, valuations are then negotiations on your value and how well you can sell it and how well you can say you can negotiate to your own terms.
Okay, so I'm thinking it's more of a calculation than a negotiation, but it's the other way around. Like, I know there's negotiation in there.
Yeah. There is a calculation and there's a negotiation, because you can do all your calculations and then an investor will be like, nah, it's still not worth it. I don't think we should be paying this much for it. Yeah.
Okay, that's fair. So when people are doing their valuation, so again, since I was so focused on the equations and the calculation side, I assume that there would be a lot of work that you have to do. So I know that when we were doing some of our ecosystem hangouts with FCMB, one of the things we were saying is that people have like a terrible financial track record, not in personal and business accounts and different things like that. So those were some of the things I was suggesting, like separating your accounts and different things like that, because you're going to need it when it comes to the valuation.
Oh, yes, you do need that. You do need that. You need to, have your typical projection, your profit and loss sheets, and all those things. You need that. Now you don't need an icon. If you're in Nigeria, you know what an icon is. You don't need to be a guru in that, right? But you must know the basics. So when you see your profit and loss statement, you'll be able to tell out, pick out the various segments. You must be able to. You can pay someone to do your projections for you, but you must be able to interpret it, right? So that when you're calculating your valuation, you're taking all those numbers into consideration and saying, if you're going to be worth this in 10 years' time, then I think our valuation at this point in time is this. Now, I have to put a note of warning. Now, valuation across various markets can be very different. If you look at LATAM, that's Latin America, if you look and see similar companies to Nigeria, the valuations in that side of the world is way higher compared to Nigeria. But I mean, what's the difference between Mexico's economy and Nigerian economy? It's as bad. Colombia's economy is as bad. However, their companies have higher valuations. And guess what? Spending power and the appetite of the investors. So because their market they have more spending power in the market and the investors have more appetite to spend there, you see that those guys can raise their valuation at ridiculous amounts and investors will not budge because there's a lot of money chasing them. However, on the African continent, it's a different ball game. Yes, money is pouring in, but money is pouring in and chasing very few people. So you have to be careful not to overvaluate yourself so that money doesn't miss you, right? That money doesn't end up going to the people that shouldn't be getting it. So you have to be careful. You can't wake up one morning and say, oh, Clubhouse raised that X billion, so my company is now X billion. It won't work. So you have to take into consideration the market that you are in, when I mentioned, the comparable method, that's where sometimes comparable method can fail you. Because if you look at India, you think, okay, well, similar market, similar situation, similar possibilities. So I'm going to put my valuation as a similar company in India. But India, there's more money in India. India is an advanced ecosystem. And usually people, because so much money has gone in there, people raise at higher valuations. So you can use them as a benchmark, but you have to be careful not to place yourself on the same level as them. Now, I'm not saying your technology is not the same as them. I'm not saying that you're not even as smart as those guys, but if you consider the market and consider the amount of money flowing into this continent, you have to be very smart and careful around your valuation.
Gotcha. So I think you touched on a few, but were there any more that you wanted to add? Things that people should be mindful of when it comes to preparing for it. I'm all about making sure that you're set up for success, as opposed to once you go and say, I want to do something, and you realize there's some things you should have been doing for 6 months before?
Well, very first thing, which you sort of you touched on, is men have records. For goodness sake, as an entrepreneur, you're not a single person, you're not a freelancer. Have records, which when I say records, like let there be records from of the money coming out of the company accounts. Pay yourself, and if you're not paying yourself, make sure you're not spending company money on personal stuff. Balance your books. Do an audit. There are organizations or there are startups that are giving you accounting services at very discount rates. There's one called Accountier, right? Now, we have gone at the days where we say lawyers are too expensive. Startup lawyers especially are too expensive. The services are everywhere online. There are platforms that even allow you to do those things where they will tell you, they'll help you build your cap table, that it will help you do so many things that will help your company in the long run, right? So make sure you have records, number one. Number two, avoid undervaluing yourself. So you know how I said, take into consideration the market and all, but you must be careful to sell yourself at the level that people will be interested in investing in you. Sometimes investors run away from companies that they think are undervalued, because that means they're not capturing the true value of what they're building. And when they go on to raise subsequently, the investors will not make as much money as they ought to make. Then thirdly, you have to avoid overvaluing yourself, which means setting your valuation so high that everybody's running away from you. Now, the problem with that is that even if somebody eventually invests in you, you have to put in double the effort to raise again. Here's why. For every time you raise money, your value has to go up. So imagine if you're starting at a very, very high valuation. That means the next time you raise, you have to double it or triple it, which becomes extra work. That means you have to, you have to put so much pressure on yourself to deliver on your business. So you don't want to be in that situation, because, man, investor stress can be a lot of problems, right? Investors, yes, I work in that space, but we investors can be a pain in the ass because we are taking other people's money and investing in you. So you have to be careful. And then I need to talk about equity. You need to be careful around equity, right? So yes, I know you're raising money. We've spoken about valuation. You've come to a certain valuation. Be careful the amount of equity you give out to investors. For aggressive capital, and unfortunately it doesn't happen for everybody. We understand that you need to feel ownership of your company to give your all. So we will not come to ask you for 30% in your company, 40% in your company. But there are investors that do that, and you have to be careful. You shouldn't sell your company or sell your life work almost immediately just because you want a few $1,000s. Yes, I'm saying a few $1,000s because if your company ends up being extremely successful, that initial first money you took in, that money you took in at first might be chicken change. Also, while raising your valuation, you must be open to feedback from the investor. So if the investor says, I think your valuation is too high and you should bring it down a bit, I'm not saying bring it down to 30, but bring it down a bit. You should actually do it, say yes. Reason is 100% of something that is worth nothing is nothing, which means if you like you raised your valuation so high, you have 100% ownership of your business, but nobody's investing in your company eventually dies. That's nothing. So 100% times zero is nothing. But if you give out 10%, 20%, even if you reduce your valuation a bit, and your company still lives and continues to make money and continues to grow, guess what? Even if you owned just a bit of that company, you've gotten you might get millions of dollars back. We've seen situations where people exited their company at Series C or D and they had only 10% of their company, but they made over 100 million. Obviously, it's not the case for a lot of people, but it happens. So 100% of nothing is nothing, but 10, 20, 30, 50, 60% of something can still amount to something. So be open to getting investment from people and be open to that conversation on valuation. And I think lastly, I think you should take the equity conversation very serious. So 2% of equity, 2% change of equity can determine a lot of things, right? So be careful as to how you do your equity allocation, who you give equity. Typically where you grow your business, you give your co-founder equity. You make reservations for equity for your employees. Very, very important. Know that at the early stage, you cannot pay everybody, but you can motivate some people by equity and say, hey, if you're part of my company for the next 5 years, I'm going to invest 10% of my company to you, which means over the next 5 years, this person is going to earn equity worth 10% in your company. Very, very important. This is how you can attract the biggest talent to your companies when you cannot pay them. Yeah, so that's my advice around, the valuation and equity conversation.
Okay, so you touched on all the formulas, you've touched things, and then we've touched on how important is it that the founder can do the valuation of their company versus paying somebody. I think you touched on that one.
Yeah.
So I think we touched on most of this stuff. So great, awesome. Were there any other finer points, any other like pro tips or anything else you want to drop with people when they're trying to actually really figure this out? Any resources or things like that that you would direct people towards?
Yeah, I can send you a link for an article that really breaks down valuation, right? I probably try to paste it in the chat section now. But lastly, nobody succeeds as an island. So look for entrepreneurs that are building in your industry and come and talk to them, right? And and let me talk about the power of community. It's very, very important. Join a community of entrepreneurs. Don't just use your Twitter and your Facebook for competition analysis or for gisting about, Ronaldo and Messi. It's all good. It's fine. We all want to wind down. We want to have fun, right? But also use it to build your business. How are you growing your network to fit where you were going to? So it's what I said I did there. Grow your network to fit where you're going to. So if you're planning to build a fintech company in this space that will be as big as Flutterwave, then you should be interacting, figuring out who the friends of GB or who the friends of the founders of Paystack are and being their friends. And then you go a step further, ask them to introduce you to this. And then one day you talk to him, man, I love Flutterwave. I love what Flutterwave is doing. You're now trying to build a startup similar to Flutterwave. What were the lessons you learned at the beginning, right? So leverage your network to learn stuff. And then you can ask them questions around valuation. Because unfortunately, yes, I know that we grew up in an environment where competition is, always hammered. Look at your brother there, does he have two heads, right? But it's not always the case. If you get a no, if you ask somebody to say, maybe a leader in the space, say, hey, this is what I think my company is doing. This is my current valuation. What do you think? And he says he doesn't want to talk about it. You won't die, right? You move on to the next person. But that person might probably have valuable feedback for you if he agrees to look at your statement or agrees to talk about your company. So your network is actually very, very important, especially in this continent. I have found out, and I'll keep on saying it, that more of the cash goes to people that are referred. More of the cash goes to people that have the better network than people that are actually doing the work on the ground, unfortunately. So you can bid out there, write the best code, you have the best idea, best company, but nobody is investing in you because nobody knows you. You don't have the network, nobody's advocating for you. So grow your network, be with the people you want to be like, or you want to grow and then engage with them. It's not all about, when he tweets football, you go and discuss football. Engage with them. And so a good example, I like to use example, Astemota talks a lot about, his experience growing a business on the African continent. Sometimes he shares lots of stuff, some stuff that I think maybe his handlers will even be annoyed with him to say, hey, why did you say this? Right? But you can jump on it and engage and say, oh, Astemota, I saw what you said about this, but I don't think so. I think that if you do this, this is what should happen. What do you think about this? You see my approach. I engage and I ask for his thoughts. Astemota will respond back, say, no, we know in 1980 something, this is what happened. This is what I think. So, right, engage. By the time you engage, trust me, you become friends. You don't know how it happens. And because the ecosystem is big but quite small, those engagements would actually come in handy. He might be in the room and somebody's talking about you and he goes, oh, I spoke to this guy. I think he's a very smart guy. And then that could just be the key for you to get your investment. So grow your network. Your network is so important.
Amen. All right. And on that one, I appreciate it, man. I appreciate you taking the time to give us this good information.
Thank you, Sean.
You really simplified it. You really simplified it. So it was something that when I raised my $1 billion company, but now it's like, okay, it's not. There's different ways around it. One of the major takeaway from that is you said it's an art, not a what again?
It's not a science, so it's not all formulas. It's an art. It's how you do it.
Gotcha.
It's in the how.
Awesome. Okay, I dropped the link there. Man, I appreciate you. So until the next time, bro, I wish you the best. If anything, I'm going to reach out and ping you in the background, but
Sure.
two-way street. All right.
Sure. All right. Take care, Sean. Bye.
All right. Bye. All right, everybody. So that concludes our episode there. As far as the interview portion goes, I believe he touched on some really key points. Again, it was actually the reason why I brought him in. When it comes to the investment space, that's a big bro to me. So yeah, I was really kind of like, all right, I want to make sure this thing is whatever. Because again, start seeing all of these different numbers and formulas and different things. I will say he's saying basically in some cases people will use what is called the discounted method or any number of those other different ones. And I know that in the previous some of the previous conversations, especially when we were talking about setting yourself up for setting your goals that generate revenue. I know that I got into a few formulas there. But again, it's very comforting to know that it's not to say that it's not that serious, but that it's a bit simpler than we thought. So again, he laid out four different ones. So there was the comparative method, there was the scorecard, discounted cash flow method, there's the projected revenues method, and then there's the cost to duplicate. One of my favorites is the cost to duplicate. And again, he did say that's the simplest one. I would have actually thought that the comparative method, just to go and see what another company is doing and say I'm the same thing, would be the easiest one. But I think the cost to duplicate is the fairest one, especially when you add in your projected sales. I think from a startup perspective, now that he's explained it to me and the wheels are starting to move, my personal opinion, again, I would say is that looking at the businesses I've connected to, I could see a lot of them looking at this is how much it would cost, or this is how much I've put into my company. This is what I've invested in it. And this also taps into it. Now, again, I've said this so many times, kings and queens, know your worth. Because again, when you are formulating these different things, you need to know how much money your time is worth. And for me, especially when I'm dealing with my interns, when I'm dealing with early stage entrepreneurs, one of the major things I push is knowing how much your time is worth. What I did to calculate how much my time is worth, which I'm not a greedy person. I moved to a developing country with an economy where at a certain point I can start positioning myself to allow my money to work for me. So what I've calculated my time at is $40 per hour within this continent. The $40 an hour is a breakdown of I need to make $50,000 to $60,000 a year to cover all the bases, have enough to start investing, making my money work for me, live comfortable, and all those different type of things. Not to say that that's all I want to make. I know that the least amount I will charge for my time is $40 an hour. So when you go to the cost to duplicate method or any of these different things that are calculating how much you've put inside your business, you also need to put in there how much time you've put into your business. So when they were talking about how long did it take to do market research, how long did it take to build out your business plan, all of these different things are, again, when you look at how much time it took to do it and how much time your time is actually worth, that's where you can actually use that to contribute to boosting the valuation of your company when you're pitching these things to investors. Because again, investors in many ways, they've made a lot of money or they're working with people who have made a lot of money. So they know how money works and they know value is something that needs to be communicated through every single process, or you're not going to capture everything that's going on in the company. So if you can't value yourself, you definitely can't value your company in a way that's going to help them get higher returns from a higher value. You're not going to give that value to yourself. So again, if you're having a conversation and it gets down to the nitty gritty and they're like, why did you say you put this much into your company, and you have a reasonable amount, and part of that is saying that I put my hard-earned time and effort into it, this is how much it's worth. Again, if other people are helping you, maybe they did it for free, but it's saying that value of time was put inside of your company. And it's up to you to be able to assign a monetary value to the time that's going into your company. So again, even after this conversation, another thing that this cleared up for me is that I thought valuating your company was something that you would potentially have to wait a while to do. Wait until you're a more mature company. Wait until you hit, like, you're making a certain amount of revenue. But with the methods that he's saying, knowing that your valuation is always going to be fluid, because part of how you evaluate your company is the market that you operate in. And again, he used an amazing example with COVID. People who are worth $10 million before, they're like, nah, bring it down, son, scale it back, So again, this made the entire process of valuation more relatable for me, to the point where now it's like, oh, okay, there's like a couple of companies I dibble and dabble in, nothing that I've gone full stream with, but things that I've had to invest to get them to the point where if the money comes, I'm prepared to process it and give value to a person in a way that, is mutually beneficial. So now I can actually go and value those companies as well. Even the companies that I may have in my mind that I've not committed, once I do commit them to a business plan, again, part of that will be knowing what the value is. And again, knowing how much time I put into it, how much the value is, that informs me on how much I should charge for my product or service, all of these different things. So again, you need to be building your business models around value, the value that goes in, the value that goes out, and what people take away from engaging with your product or service. Again, I learned a lot from that conversation. I think that I don't know if it was as informative for others as it was for me. But again, if you go back through the previous conversations we've had with investment readiness, the goal setting for generating revenue, and some of the other learning modules on the website, especially where the investment knowledge is coming in at, it connected a few dots. Again, I was afraid of something, so I wasn't kind of investing a lot of mental power into figuring certain things out. It was like, I'll get to it when it becomes more relevant, or when I have a deeper understanding. And, as you can see, things do not lay and fallow for long. I will figure it out, or I will reach out to somebody. So again, just like Owen was saying on the thing, it's your network that's going to take you to the next level. Today, in this presentation was a perfect example. There was something I wasn't that confident about. There was something that I didn't feel like I was that well versed on. And by talking to somebody that speaks my language, somebody that I know, somebody that I'm comfortable with, somebody that I've built a relationship with, he's able to give it to me in my terms, knowing my level of understanding. And now that I figured that out, it's kind of connected all of these other dots. So again, please take these lessons to heart. I had an amazing time having the conversation. I have an amazing time just creating this information for you guys. It's not just for you, it's for everybody. Even if you don't find valuating a company to be interesting to you, pin it down, like save it, like leave it somewhere where you can go back and find it later. And of course, make sure you share it with other people. Historically, currently, again, I wrote an article about this. You can find this on the website as well, the exclusion of Black people in technology. These are the two major places where we don't have a horse in the race. It's technology and investment. Again, we're not playing an important enough role in creating technology that creates value at a high level. And then we're also not adept or participating in at the highest level with enough numbers of us doing it. We're not participating in the process of allowing our money to work for us. I know there are so many times where you can look out and you can see people living a certain type of lifestyle, but they don't work hard like you work. Like, look, it's not meant for you to work that hard. Like, I was seeing a tweet going around the other day, like, we were born on this rock that had everything for free, and we decided to go and create bills. You know what I'm saying? We're killing ourselves and breaking our backs to pay these bills because a lot of us, we weren't given the information. We weren't taught how to make our money work for us. There are like these little small, stupid, silly decisions that you can make in the positive direction that can change your life over time. And it's just a function of us not knowing about it. If you're looking online, there are people who are using no money down in different ways and partnering together to buy real estate, to buy properties and do different things like that. The options are out there. The ways are out there. And we have to like take it down step by step by step. Again, that's what I did today. Today was something, again, I know I hope I tried to sound confident about it. But I also wanted to be real about it and just let you know, like, hey, I need to pull in a professional here. And I will do that. I will do that. So I'd like to say that please feel free, trust the information that I give. Typically on my resources that I provide, there are links and different things like that that I use to pull information from, so you can source it and know that I'm not just pulling things out of thin air. Now, there are some things that I just know. I just know it. It would be very difficult for anybody to find a book or any other resource that would give you the perspective of somebody who's seen the things living in the deep South in Mississippi, being a military brat, being a preacher's kid, like having these different lenses with how I see life, and then transporting myself to the African continent to even gain further perspective. I think in that way, and I'm saying this because I also wrote an article on this, the miseducation of the Black entrepreneur. But I'm saying all this to say that you do need to value your perspectives. Again, a lot of what we're doing, a lot of the ways we're moving needs to be centered around creating value, and not just value in the short term, but value in the long term and value that you can build off of. So again, I'll leave it there. I don't want to start sounding like I'm preaching, but you know what I'm saying? Y'all need to step it up. Y'all need to get into securing this bag. Y'all need to learn how to make this money work. You need to value yourself. It's going to be hard to have anything else working if you can't find value in yourself. Me, and in these two hands, I don't care what goes wrong. With these two hands and this right here, I can make something happen. So with that one, thank you for joining us today. Please follow us on all of our social media channels. Look at us for Burroughs Enterprises, Abroad While Black, or Facebook, Twitter, Instagram. Please go to the website. I prefer people going to the website, and I prefer people create their own websites. Again, the whole idea is to create your own environment where people can get to know you and understand your logic and your viewpoints, control your space. And with that being said, yeah, sign up, subscribe to the newsletter. That way you're going to get the calendar, you're going to get past events and different things that we've done. And I'm just going to keep you in the loop. So again, as usual, if you enjoy this content, please do the robot on that like button. I love y'all. I'm here for y'all. Peace.